Hello and welcome to the Your Financial Pharmacist Real Estate Investing Podcast, a show all about empowering pharmacists to achieve financial freedom through real estate investing. I'm Nate Hedrick, and each week, my co-host David Bright and I explore stories from pharmacists all over the country who are achieving their real estate goals while maintaining a meaningful career in pharmacy. Whether you're a first-time investor or a seasoned pro, we're here to provide education and inspiration about the world of real estate. Please note, this podcast is intended for educational purposes only and should not be considered financial or investment advice. Hey, David, how's it going?
Hey, good. Thanks. How you doing, man?
I'm good, except that I just saw mortgage rates hit like 7% for the first time, so I'm kind of freaking out. Can we talk? What's going on?
Yeah. So we are recording this episode in early October 2022, which, in case you're listening to this years later and you think, why did these guys not know what they were doing at the time? The interest rates have gone 30-year conventional mortgage rates over the past 2 months have gone from 5% to 7%. And they've been kind of all over the place in between there. But as we look back from a year ago when interest rates were 3% and now they're at 7% here within the last week, that's a substantial change in interest rates and can have a substantial impact for monthly payments, whether you're an owner occupant or whether you're an investor. So certainly a big shift worth talking about for a minute.
And I know that if you look at the historical averages of interest rates, 7% is not that big of a deal, right? Our parents or different generations were buying 18% mortgage rates. It's not insane, but for those of us who've been living in the 0% rate market and 3% mortgage market for as long as we have, it feels like a really important change and something we want to talk about and really kind of dive through. So,
yeah. And even just to break out the math for a little bit, if you're looking at a $200,000 mortgage, if we just use a round number of 200, and then for those in San Francisco, you can multiply that by 5 or whatever makes sense in your market. But if we just do a $200,000 mortgage, 3% rates last year to 7% rates last week, that's almost a $500 per month increase in payment. Not quite, almost $500 a month. And so when you look at that in a monthly budget, again, whether you're a renter, you're trying to use that as an investment property, whether you're living there personally, that's a big chunk to cover.
Yeah. And we were brainstorming, David and I, about how to present this, how we were going to talk about this topic. It's a complicated topic and there are a lot of, varying opinions, right? So we thought maybe we do a deep dive, maybe we reference back to an article that we read. There are plenty of good ones out there. We thought about bringing on a guest and ultimately we decided on this hodgepodge that we're about to present you guys.
Yeah, because we were a little hesitant about just a deep dive because then it can feel what's the Nate and David opinion? And then we were hesitant about just an article because then it can feel just go read the article and you don't need to waste your time with the podcast, right? And then we were also hesitant with a guest because any one person's opinion right now is just one person's opinion of a very complicated topic. So yeah, we were a little stuck on this one.
Yeah, so instead we decided to do all three and somehow cram that into a half an hour show for you guys. So again, our goal was not to have a 3 hour long podcast. Our goal was to take a few snippets from each piece and kind of present them to you guys just so you can start making your own opinions. We were lucky enough to interview someone from my own brokerage in a different area from me, but from Berkshire Hathaway here in Ohio. His name is Jim Carmichael, broker from the Cincinnati, Kentucky market, mostly operates in the Kentucky area, but phenomenal guy. He's been with our brokerage for years and just has a really good pulse on the market, especially in the commercial real estate space. And so I thought we would be able to bring him on just to do a couple of snippets, to be able to share some of the knowledge that he has with us.
Yeah. And Nate, I like what you said about forming our own opinions, because I think different people are going to see different things in different sectors of the market and different geographies. It's hard to say that the market is going to do this for the next year and have anything definitive behind that. So, the last thing that we want to do is pretend to have a crystal ball and know where the market is going to be in a year or 2 years, because we just don't know. But if we do step back and look at a lot of that data, what would a pharmacist do? They'd gather a bunch of data from a bunch of different sources, right? And then come to some sort of conclusion that could help them sleep at night. So we thought that we'd, look at a bunch of predictions from a bunch of smart people out there and then, pick apart some other opinions from there.
So there's an article just about every day about which way the market is going, right? But we saw one recently that we liked in particular from fortune.com, and we'll make sure we link that in the show notes. But this recent article was talking about the Wall Street predictions for the market specifically, and I thought that was really intriguing.
I'll try to say it before Nate says it, as the classic realtor line that all real estate is local, right?
Mhm.
And so, the national market can do one thing and that may very well trickle down to a local market. Local markets may move in similar or opposite directions or at a magnitude that's more or less than the national market. And even within a local market, like if you just pick a small city, one block could go up while another block goes down, even just because like a new school or a new park, or maybe this ugly boarded up house on the block got renovated and looks gorgeous now. So like there can be 1,000 different reasons why a particular house in a particular town would go up or down in value.
Absolutely. So while we're going to talk about national trends and things we're seeing in our markets or in the markets of the people that we're talking to, it's really important to have your own local agent that knows the market, can help you keep track of what's going on, help you understand what might be changing, what things are coming down the road. Again, a good reminder that that agent is a key piece of your team. If you are looking for an agent and you're out there wondering, how do I find a great agent? How do I find somebody that's investor friendly? We also have a solution for that. If you head on over to yfprealestate.com, you can get access to the concierge service, a free service where you can connect with me, learn more about what you're trying to accomplish. We'll talk through things like budget, what your goals are, where you want to invest, and we'll get you connected with a local agent there who can really take off and be investor friendly and on your side. So realize that that local knowledge is super important and not to be something to overlook when you're listening to us talk about the national trends that we're going to discuss.
So setting aside the issue of block by block can be very different. If we do zoom out for a minute and just try to look at national trends in general, again, what would a pharmacist do? You'd go look at what a bunch of smart other people have said when they've done their homework and done their research and get some of that information, get those viewpoints. So what was interesting about this specific article that we keep referencing back to, again, in the show notes, there's groups like Morgan Stanley, Goldman Sachs, Moody's Analytics, Fitch Ratings that talk about those statistics of what they're looking at over the course of the next 12, 14 months, what they predict 2023 will look like. And then just for context on these numbers, they backdrop all of this analysis against the 2006 to 2012 market drop, because unless you were investing well before 2006, when you hear market drop, it might trigger memories of this, 2006 to 2012 area where they showed peak to trough price changes of a 27% market decline. So that's kind of the backdrop. They set that there and then they start predicting or discussing what these predictions are for the next year. So Nate, in the context of these 7% rates, in the context of all this that you saw, what did you get from this article?
Objectively, if you look at it, all the groups really showed that they were predicting a decline in the market, right? They predicted that prices will fall by the end of 2023. How much they will fall varied dramatically. And what I liked was that they kind of hedged, right? They pulled a Tim Baker and said it depends on what's going to happen, right? So they said that different groups had different scenarios based on if we saw continued price growth or if we saw continued market declines or if we saw continued interest rate rises, or if we saw those interest rates start to fall. All of those scenarios and all those factors obviously play a major role. So they kind of gave an answer and then said, but if this changes, here's how it might affect the market. So I liked the kind of the baseline that they established and then how it might deviate from baseline based on what might happen.
Yeah, and a lot of those baseline predictors ranged in that kind of 7 to 15% decline of the market, which was interesting to see some level of convergence among all those different groups. And a lot of them gave ranges. Not all of them picked like a precise percentage that they're thinking, but ranges in there as well. But again, with that, you brought up Jim earlier, and I think that we wanted to get a lot of different perspectives on here. So Nate, you did ask a question of Jim, and I think let's jump to that clip if we could for just a minute here.
For those who may not be paying as close of attention as some of us do in the space, maybe give us a 10,000 foot overview of what's been happening the last 6 to 12 months and kind of where we are today with the market that we've been dealing with.
6 to 12 months. You have runaway inflation that the government is not controlling very well. I'll pat myself on the back. In 2019, I put out a white paper on LinkedIn and a few other places in social media that basically predicted everything that's happening now. But I said it was going to happen in 21. The only difference is COVID hit. Didn't know that was going to happen. So
Come on,
every
Jim.
every single thing I expected to happen in 2021 is happening right now, almost to the day. So we have the inflation is more out of control. So think of it in terms of this. The out of control pricing that we've had in housing on the way up was due to all the money that they threw into the market. And now that they're pulling that money back out of the market and trying to get control of it, we're going to have the same problem on the way down. So interest rates have to continue to go up in order to get the recession under control, to get inflation under control. The recession was inevitable. Even when I wrote the paper in 19, I said, it doesn't make a difference who is elected president. What makes a difference is how the administration responds. Some folks think I'm very doom and gloom on what's going to happen going forward. In the last 6 to 12 months, essentially, if you're looking from over top, between interest rates going up and they're going to continue to go up, you have a lot of buyer fatigue. You had grossly overinflated prices of housing. It's the only product on planet Earth that I'm aware of that somebody will tell you that it's only worth this much, and yet you're still willing to pay more just to have it. Anyway, so in the last 6 to 12 months, you've seen the market go way high, and now you're seeing the adjustment as interest rates have gone up. You've seen the market slow. You've seen the inventory start to slowly come up. You've seen interest rates are certainly much higher. I think the other day I saw they're like 6.95. In commercial, it hits us even worse. It hit us first. Commercial is always hit first and worst, and we're the last to recover. So our interest rates went up back in March. A partner and I were supposed to close on a 12-unit deal. We got quoted a rate of 5.5% fixed in February. When we went to close on April 16th, it was 7.625.
Wow.
Killed the deal.
Yeah.
Didn't cash flow anymore. You can't sell a 7 cap property at a 7.5% interest rate. It doesn't work.
So there's a lot that Jim says in there. So I want to unpack that for a bit, right? He gets into the pace of the rate increase, which is something we mentioned before. And I think there's a lot of us have seen that in headlines. But if you haven't been watching the rates in the last month or two, rates have not just gone up, but gone up by multiple percentage points in just a couple of months. That's the part that I think is really interesting. In fact, it was only a couple of months ago that we were seeing 5% rates, and now we're at 7%. So it's not just the fact that the rates are quote unquote high, it's the rate at which they've been doing that, the pace at which they've been increasing.
Yeah. And in the residential space, people oftentimes they find a house, they make an offer, they get the offer accepted, they get through inspections and all those things. And at some point, relatively early in that process, they lock their interest rate. And so that rate lock is really valuable if you're in an environment where you believe that rates are going to move up pretty rapidly. And that can help to hedge your bet. In some of these situations, it may take 30, 45, 60 days to close from the point at which you get the property under contract and you've come to agreement with the seller to the point at which you close. And in Jim's example, rates moved quite substantially. And in the commercial space, it's not as common to have that lock situation early on there. So without that rate lock, there's potential for continued movement in the rate, potential for that payment to shift. And so there's a little bit more risk there if you don't have that rate lock situation.
And when you're looking to make a property that produces cash flow, when you're looking to purchase a property that produces cash flow, the mortgage payment can be a big factor that influences that number. And a lot of the commercial properties we're talking about can be several millions of dollars or more. So even a small change in rate can have a huge impact on that payment. And so what Jim is saying, and what we can unpack a little further as we talk more, is that when you have a property that produces a 7% unleveraged return, and then you try to apply a 7.5% interest rate debt to that equation, your cash flow essentially evaporates, and the deal might not be worth doing anymore just because of that rate alone. Everything else might still be the same, but that rate change can really make the big difference and ruin it.
Yeah. And there's not a lot of pharmacist investors that are jumping into a multi-million-dollar commercial real estate as their first investment, their first transaction, right? So some of those headaches of rate lock and some of those things may not be there, but it certainly underscores the value there, and it underscores how cash flow can change and how underwriting, your deal, looking at the numbers on that transaction can be really important to understand what that cash flow is and how that cash flow can change if the mortgage rate changes.
All right. So David, we mentioned earlier on that real estate is local and that national trends do not necessarily reflect local trends. So we asked Jim about this too. We wanted to see, what some of the regional changes might be looking like, what some of the national trends looking like. And he had a pretty bold response. I want to take you to that question that you asked him and what he spit back at us.
So you got me curious with this prediction of values dropping, because I don't think that you're alone. I think that a lot of people have seen crazy value increases over the last couple of years, and people saying like that's got to settle back down at some point. Do you see that as a nationwide average? Do you see that as some places are going to get hit really bad and some places may be fine, or is that just an everywhere thing?
Oh, it's an everywhere thing. No place will be fine. It can't be. Like the last recession we had, the 08 recession, 09, 010, it went from 08, 09, late 08, all of 09. That recession, we had seen an increase of about 20% in value. Nothing was grossly overinflated, but it did go up. And we saw a drop that was equal to that. It was 15 to 25% drop. In this market, in coastal markets, it was 40 to 50% drops. Then in like Vegas, they got crushed. Mm-hmm. So this being one of the more conservative areas of the country, middle America, from like mm-hmm. Kansas through like Indianapolis, Louisville, Cincinnati, like that middle America part, we're as steady as they get. I will say this, if pricing doesn't fall at least 30% through middle America, it's a true blessing.
Yeah, so that's certainly a more pessimistic view than the Fortune article portrays, right? But it does underscore one theme that's similar, and that's that the market can be different in different places. For example, in that article, Moody's does a breakdown map of the U.S. into different areas and puts predictions on how relatively undervalued or overvalued different markets are and what some of that changing impact may be in different parts of the country. And they've continued to update maps like that. So you can go out and you can find these maps and see. And that change between areas, though, is really fascinating. So it's a particular take home point. If you're an investor that's looking to invest out of state, there's a lot of considerations if you're investing in other markets. We've talked with previous podcast guests that invest out of town, and they look for where they might have connections in that town or where they might have familiarity in that town, or where prices might be a little more achievable than where they live. And so we've heard different things like that. One additional factor may be, what do some of these predictions look like for those different parts of the country? And is this a season where looking at areas that may be more or less undervalued, overvalued, all those kind of things, may make sense to play into that equation when you're looking for a market to invest?
Yeah, and I think, you and I, right, are still actively looking for ways to invest, right? We haven't turned it off. We haven't stopped and just waiting. And so I think there's a lot of others out there that are doing the exact same thing. They want to break into real estate investing. They want to continue investing in real estate. And so we flipped it on Jim right after that to say, Jim, what do you think about people who are starting out? And so he had some great advice. So I want to take you to that question and his response as well. What's one piece of advice you'd give to a pharmacist or any professional really contemplating a start in real estate investing, especially with, again, your outlook looking forward? If you're thinking about starting today, what's one thing you'd do to kind of get off on the right foot?
I will tell you exactly. I had this conversation today with he's a relatively new investor into the market. He has a couple of properties, and he was referred to me today. And what I said is, be patient. Don't be so eager to spend your money. Good deals are coming. If one comes, anything that hits the open market at this point isn't usually worth buying, right?
Just wait.
It's just overpriced. If you can find something off market, the best advice is there's never a good time to make a bad deal, and there's never a bad time to make a good deal.
I like it.
That's what you always remember that. Like, if you can find a good deal, don't change your parameters to squeeze into a deal. The deal needs to fit into your parameters. And when those come along, the market is going to be getting aggressive. So be prepared. Like, you're going to be able to, make cash offers, close fast. And if you have your team in place, that's not that scary.
Yeah, I like how he echoed a lot of things that we've been saying for a long time, that if you know your numbers, you've practiced your math, you've done your homework, that can really help, particularly a detail-oriented, risk-averse pharmacist that likes to do the math and check the math and all that. That can really help with that confidence to help you move forward when the time is right and to help identify the property that does make sense for you so that you can make a move. And really, too, I like that he speaks to the danger of forcing a deal just because you really want to get a house or you really want to start investing. Like that can be dangerous to force something that doesn't work.
Yeah, 100%. It's always a bad time forcing a deal to work, but now particularly so. You don't have the advantage of the rising tide that we've seen in the last couple of years. I mean, truly, if you look like backward about a year and a half, 2 years, you could make mistakes, and the rising tide of everybody else's real estate investments taking off covered up a lot of those mistakes, and it didn't seem nearly as bad. So when you've got a market like this where it's softening a bit or there's a little more risk built into it, you really can't afford to make those errors and try to force a bad deal.
Yeah, absolutely. I think one of the things we wanted to do, particularly for folks that may be listening to this further in the future, and all these details may be different even just a few months from now. So as you continue to do your homework as a wise investor and you're thinking through these kind of considerations, we wanted to hit a few tangible next steps to help put this all together into something that you can move forward with. So Nate, I know we made a list before we started recording. Do you want to run through the list overall real fast and we can hit each of those points?
Yep, super fast. So underwriting conservatively for values to potentially drop. You want to make sure you're underwriting conservatively. Looking for multiple exit strategies, something we preach all the time. You want to stress test a cash out refinance. We'll get into what that means. And prepare for a sale of a house to not be as quick. You cannot expect these one-day listings to be the norm any longer. It's just not going to happen.
Yeah, so let's jump into that first one off the list, underwriting conservatively, which is really just doing your math to see what happens if. Like what happens if we see values drop as an example here. So if we round number example, I had a wholesaler one time that sent a property that was a $70,000 property that needed $30,000 of work. So I would be all into the property for $100,000 at the end of that process. And in this case, that property was probably worth about $100,000. There wasn't really any built-in value by going through that work, but it was in an area that was improving. The rent would be outstanding. At that point, it was like $1,500 a month was the estimate on a $100,000 property. So great cash flow. Like that all looked really, really positive. But there wouldn't be any equity created through that rehab process. We'd be essentially getting into the property for what it would be worth in today's market. And while I could see an argument for why some investors may do that in certain seasons, maybe a couple years ago, someone could have done that and done really well. Like you mentioned, the rising tide, that $100,000 house may be worth $150,000 today. And that, the person that bought that property, that may seem really positive. But if we're thinking that the market could drop, like a lot of these predictions are, then walking into and paying full market, full retail for a property today, that can be problematic if you're thinking that values may drop. So one of the things that we both talk about is in our own investing is looking for value add projects where just using those same round numbers, if I was to buy a $70,000 house and put $30,000 of repairs into it, in today's market, I might want that to be worth something like $125,000 when I'm done, not $100,000, so that if the market drops, I've got some room to go before it would put me in an underwater situation. So we're building in cushion to our investing by looking for fixer upper value add projects to withstand a drop in the market.
Yeah, I love that. And that's just one of the ways, right, that you can underwrite that deal more effectively, right? Construction is a great way to do that. Other options are buying smart, right? Getting a great deal, finding it off market perhaps, or buying it fast with cash for somebody that's in a struggling position. You could buy tenanted properties that are less attractive to maybe owner occupants or that have some headache built into them. There are lots of ways to still find deals, but you have to be able to build that loss of equity into it so that if it does occur, you've got some cushion built into what you're doing.
Yeah, absolutely. Nate, the next one on the list was multiple exit strategies. Can you walk us through that one?
Yeah, this is something that, again, David, you and I have talked about a lot in the past, something I always cover with my clients, that if we're going into a property, the way to truly mitigate risk over the long term is to have multiple exit options. And those exit options, generally speaking, are either selling the home, renting the home and potentially refinancing it, or renting the home and leaving it alone, or some combination, right? Where you're doing some renting it for a while, selling it in a couple of years, right? But you have to have opportunities and options to be able to get away from that property if you need to, right? A lot of times what happens is people go in and they look at a deal and they say, I'm buying it and the cash flow is great. And as long as I hold it as a short-term rental, let's say, then everything is rosy and I'll be making a ton of money on this property. But what's happening is in certain markets, if you only have that one strategy, if you only have that one avenue to make money on a property or to not lose money on a property, what happens if that sours, right? The more common example I see a lot of times is people that flip houses. If you're only flipping and the only way you make money on a property is if you can buy it, rehab it, and then sell it for a whole bunch of money, if that property starts to decline in value because the rest of the market is declining, your entire strategy evaporates, right? So you really need to have multiple exit strategies so that if one of those things gets disrupted by a market that you cannot control, you have a way to pivot and sidestep. So multiple exit strategies, super important way to mitigate risk, and something that I build into every deal if I can.
Yeah, and that may look very different for different people in different seasons of life and different goals of investing. Like I have a friend even that moved into one of his flips because it just made sense that his own personal residence had gone up so much in value. It made sense to just sell that or turn that into a rental. I can't remember exactly what he did, but then he moved into the flip and then that became his house. So lots of different ways that can look for different people. But again, making sure that you have multiple options can be really reassuring to that risk averse pharmacist.
For sure, for sure. All right, you mentioned, or we mentioned earlier on, stress testing. Can you walk us through, David, what that means for a deal, especially stress testing a refinance or something like that?
Yeah, so this is something that Blake and Zach went into further detail back on episode 62 about stress testing a property with different interest rates. So one of the things that we've talked about frequently is kind of the BRRRR model, where you're buying a property, you're renovating it, you rent it out, and then you refinance the property. When you go through that process, oftentimes there's a delay between purchase and then this eventual refinance after a bunch of renovation has taken place in the property. If we're concerned about where interest rates may continue to go up, down, who knows at this point, you can run that math and you can calculate out a mortgage payment of what if the mortgage that we got was at 7%? What if the mortgage we got was at 9%? What if the mortgage we got was at 10%? What if it was at 5%? What would all those different scenarios look like? And then you can start to see, like, how much room do I have before this property no longer cash flows if mortgage rates go to X? And then you can also keep in mind then, if mortgage rates drop, at what point does a refinance make sense? Because it would drastically increase cash flow. So you can run that math in both directions. I think the thing right now is we're seeing interest rates with a positive trajectory right now, or negative, however you want to look at that. Interest rates climbing, right? I don't know if that's necessarily positive, but interest rates climbing. Then you can think through, how much further climb do I have before this property doesn't cash flow anymore?
Yeah, I think that's super important. It just gives you some guide rails to be able to look at and to consider before you take the plunge and you're stuck, right? So it's a great way to, like the name suggests, stress test what you're trying to do before you're actually stuck with it. So very important.
Yeah. And then Nate, if I can ask you, put your realtor hat on for a minute. You mentioned these 1-day listings that like never happened before now. And then we had this season where the market was so hot, where things would get multiple offers within hours. And it was just crazy urban legends coming true, right? And now things may be cooling and we may start to look a little more normal.
Yeah, I think people have forgotten what normal looks like. When I first started as an agent, and I've not been in the business that long, a normal listing was on the market for 20 to 40 days. That was pretty much standard, right? If you were really in a good spot, you got it done in 2 weeks, and you had a full priced offer or something like that. And then you compare that to what I was seeing last summer, where it seemed like every single house on the market would be coming soon on Wednesday. It would drop on Friday. They'd have showings on Friday and Saturday. Final and best we do on Sunday, and it would sell for X thousands of dollars over by Sunday afternoon.
Yeah.
And every single house is that way. There was no, it was just the normal process. And that has really started to go away. We're seeing, especially in certain markets, where we're getting a little bit more toward normal, that 20 to 40 days on market. But having said that, there are still pockets where if they're listed right, they're still flying off the shelves. I just had one recently this weekend, actually, where I was trying to help a buyer purchase a property and listed on a Friday. On Saturday, they told us they had multiple offers and the final invest was due by 5 o'clock on Friday. So it's not happening everywhere, but it's not the expectation anymore. Don't set yourself up if you're selling a property or you're trying to work within the property and sell it. Don't set yourself up to need that property to move in a couple of days because it's just not happening everywhere. It's only happening in certain scenarios, in certain markets, and if you price it really, really correctly. So just bear that in mind. I think that will continue to soften over time, especially as the rates continue to go up and the market changes. But that's something to that old school style of flying off the shelves from the last 2 years is starting to go away.
Yeah, and I know one thing that I'm seeing in my market is as an example too. What all real estate is local; things happen differently in different places. I'm certainly seeing fewer cash offers right now. So some of those like offer is all cash, will close in 2 weeks. Like if you are flipping a house or if you're selling an old rental that you have, that's a beautiful thing to have that property sell and move quickly. But knowing that fewer cash offers are coming and that mortgages take longer, they don't generally close in 2 weeks. If you are a house flipper or you're trying to get into house flipping, assuming that you will get the project done very, very quickly because you only need 2, 3, 4 weeks on the back end to sell your property, that may not be a fair assumption anymore if we see any kind of continued cooling, fewer and fewer cash offers, those kind of issues.
So a lot of great information from a lot of different sources. I guess you guys are stuck listening to our final source, which is me and David. So David, what are you doing for your own investing right now based on all of this stuff that's going on?
Yeah, and I feel like as we've talked throughout this summer into fall, I feel like this continues to change a little bit. So again, this is October 2022, what we're doing in the moment, and this isn't financial or investing advice and all that. But for me in my market, I'm still looking for opportunities. I'm trying to underwrite cautiously. I'm trying to be cautious with my math so that if the market shifts, we're still going to be okay. So I'm doing some of these things exactly like stress testing the portfolio. What's the mortgage going to look like if the rate changes? I'm not really betting on continued appreciation right now. If houses appreciate, great. I'm not going to complain, but I want to make sure that I'm in a safe spot if we see a decline in market prices. So how about you?
Yeah, we're similar, right? So I'm still looking for opportunities. We're always looking to buy if there's something that makes sense, but we're being very, very cautious at the moment. I think there's no reason to rush in. I think prices in our market are still fairly inflated and aren't really shifting yet. And so I want to be in a good cash position or in a good buying position when and if they do start to shift. That could take 6, 8, 10, 12 months. I don't know. And I'm okay with waiting. We did a lot of good acquisition over the last year or so. And so if nothing comes up, I'm not going to force it. And I think there's a lot of value in the wait and see approach, but also making sure that you're still actually looking, right? Because what you don't want to do is just sit on the sidelines and say, it's a bad time. There's nothing out there. Because by the time everybody starts talking again and says, oh, now it's a good time to buy again, you've already missed the great window, right? So I think it's super important for us, at least, to keep our heads in the game, but not make any decisions rashly and trying to really look at things with a cautious eye at this point.
Yeah, one of the other things that I love that Jim talked about was just making sure that you're continually learning too and growing through that. So one of the things that we've certainly talked a lot about is just continuing to prepare yourself so that when that time comes, you're ready to jump in. And that timing may be market dependent. That time may be as you get your own comfort as an investor that you've done enough learning, you have enough confidence, you're ready to jump in, you built the team around you. So, just because things may look iffy doesn't mean that this is a good time or a bad time for any one person. A lot of that learning and growth and confidence can happen no matter the market season.
Yeah, and keep in mind, right, we present all these opinions, but nobody knows where the market's going for sure. It could do literally anything in the next 6 months, and we have no idea. So I think just using that mindset of being cautiously careful while we're evaluating what's happening is not a bad place to be, right? It doesn't mean you can't move forward. It just needs you make sure on your own personal investing and growth trajectory, you want to do it on your own scope. Don't listen to everybody else. Nobody else knows exactly what's going on, just like we don't know what's going on. So don't just follow the crowd. Follow what your own goals are and what your own perspectives are. So hopefully that gives you guys a bunch of different opinions on what's going on in the world of real estate at the moment. It gives you some idea of where to go with your real estate investing, whether you are deep into it or are just looking to start. And a good reminder that if you're looking for more people to connect with and get even more opinions than just David and myself, the YFP Facebook group is a great place to check that out. If you go to YFP Real Estate Investing on Facebook, there's a whole Facebook group there dedicated to other pharmacists like ourselves who are investors in real estate and talk about it every day. So definitely check that out. Would love to connect with you guys on there, learn more about what you're seeing in your markets and learn more about what your strategies are for the next year or so. So would love to connect to you guys there. And again, hopefully this has been helpful.
Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard on today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with Nate or David, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group. As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content in this podcast is provided to you for your informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on this podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist, unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.